Alright, listen up. It's Monday, June 9th, 2025, and you need to know what's moving your money. This week is all about reading the tea leaves of the American economy. Forget the noise, focus on the numbers. We've got a slate of data coming that will tell us where we're headed. The big one to watch is the consumer inflation expectations. This isn't just some academic number, it's about what you, the consumer, believe will happen to prices. If you think prices are going up, you might buy more now, and that's exactly what the Federal Reserve is watching like a hawk. They want to see those expectations stay anchored, not fly off the handle. Next up, we've got the NFIB Business Optimism Index. Why does this matter? Because small businesses are the backbone of this country. They hire people, they spend money, they drive growth. This index gives us a direct line into the minds of Main Street entrepreneurs. Are they feeling confident enough to expand, or are they getting ready to batten down the hatches? Their sentiment is a powerful forward-looking indicator. If these business owners are optimistic, that's a green light for the market. If they're pessimistic, watch out below. It's a gut check for the entire economic landscape, and you better believe Wall Street pays attention. Let's not forget about the US wholesale inventories data. Now this might sound boring, but hear me out. It's a crucial piece of the puzzle. Inventories tell us about the balance between supply and demand. If warehouses are overflowing with unsold goods, it means businesses overestimated demand. That could lead to future production cuts and price discounts. On the other hand, if inventories are running thin, it suggests demand is strong and businesses might need to ramp up production. Think of it as the economy's pantry. Is it overstocked, or are the shelves getting bare? This number helps us understand the health of the entire supply chain. So, what's the bottom line here? These three data points are not just random numbers on a screen. They are vital signs for the US economy. They tell us about inflation pressures, business confidence, and the flow of goods. Together, they paint a picture of whether our economy is running hot, cold, or just right. This isn't just for the big shot traders on Wall Street. This affects your job, the price of your gas, and the value of your 401k. So stay tuned, because this week's numbers will set the tone. Booyah! Now let's take a trip around the globe, because what happens over there absolutely matters right here. First stop, China. We're getting a look at their latest consumer price index, and guess what? They're still battling deflation, with prices falling 0.1% year over year. That might sound good, cheaper stuff, but it's a bad sign for an economy. It means demand is weak and consumers are holding off on spending, hoping prices will fall even further. This weakness in China, the world's factory, can send ripples everywhere. It affects companies like Apple and Caterpillar that sell a ton of stuff over there. We need a strong China, and right now it's looking shaky. Next, we fly over to Japan. The land of the rising sun just revised its first quarter GDP numbers. The good news is that the economy didn't shrink as much as we first thought. It was basically flat, which is better than a big negative number. Plus, Prime Minister Ishiba is out there saying that rising interest rates are now a trend. For decades, Japan has been the land of zero interest rates. This is a massive shift. It means the third largest economy in the world is finally waking up from its long slumber. This could have huge implications for global money flows, as Japanese investors might start bringing their cash back home. Don't sleep on the smaller players either. We got data from New Zealand showing their manufacturing sales jumped 2.4% in the first quarter. That's a solid number and shows there's still pockets of strength out there in the global economy. It's a reminder that it's not all doom and gloom. Meanwhile, in Europe, things are starting the week off slow with a few bank holidays, but keep an eye on the commentary coming out of the European Central Bank. An official just said they can now take their time before making any more moves. That signals stability, which is something the market loves to see. The big takeaway from our world tour is that the global economic picture is mixed. We have weakness in China, a major policy shift happening in Japan, and pockets of resilience elsewhere. You can't just be a US-only investor anymore. You have to understand how these international currents are pushing and pulling on our markets. A problem in Beijing can become a problem for Boeing. A policy change in Tokyo can affect the US bonds in your retirement account. The world is connected, and your wallet is right in the middle of it. Let's talk about the king, the US dollar. Right now the dollar is flexing its muscles. The dollar index, or DXY, is hovering around 99.00. Why is it so strong? It's simple. Our economy, despite its wobbles, looks better than many others, and the Federal Reserve isn't in a rush to cut interest rates. When you have higher interest rates here than in Europe or Japan, global investors want to park their money here to get a better return. This demand pushes the value of the dollar up. For American tourists heading to Europe, a strong dollar is fantastic. Your money goes further. But for big US companies like Microsoft or Coca-Cola, it's a headache because it makes their products more expensive for foreign buyers. Now let's pivot to the bond market. This is where the smart money lives, and you need to pay attention. Bond yields, which are the return you get on a bond, have been the talk of the town. People are watching the big US bond auctions this week, especially the 30-year bond auction. If demand at this auction is weak, it means investors are nervous about locking their money up for 30 years and are demanding higher yields as compensation. That can push up borrowing costs for everyone, from the government to you when you apply for a mortgage. Think of it as a massive vote of confidence, or no confidence, in the long-term health of the US economy. Of course, we have to talk about the Wild West cryptocurrency. Bitcoin is the big kahuna, and it's been chopping around trying to find its footing. It's caught between excitement about potential new exchange-traded funds that would make it easier for regular folks to invest, and the fear of more regulation. Ethereum, the number 2 player, is also in the spotlight, with its own ecosystem of applications growing every day. Then you have the altcoins, the smaller cryptocurrencies which are even more volatile. The story to watch is the ongoing regulatory drama, especially with tokens like XRP, as governments try to figure out how to handle this new asset class. So, what's the play? You have a strong dollar creating winners and losers, you have a bond market that's sending us critical signals about the future, and you have a crypto market that remains a high-risk, high-reward frontier. Each of these markets tells a different part of the same story. The dollar tells us about the here and now. The bond market tells us about the long-term future. And crypto? That's trying to tell us about a completely different future altogether. Understanding how they all fit together is the key to navigating these choppy waters. Don't get scared, get informed. Finally, let's get down to the stuff you can actually touch, commodities. These are the raw materials that build and fuel our world. First up, crude oil. The price of WTI crude has pulled back a bit to around $63.80 a barrel. Traders are feeling a little nervous ahead of potential US-China trade talks. If those two giants start talking nicely, it could boost global growth and increase demand for oil. But if the talks fall apart, fears of a global slowdown could send oil prices tumbling. For you, this directly impacts the price you pay at the pump. When oil goes up, gas prices follow. It's that simple. Next, let's look at the shiny stuff. Gold. The precious metal has taken a hit, falling below $3,300 an ounce. This is classic market behavior. Gold is often seen as a safe haven investment. When investors are scared, they buy gold. But right now, with a super strong US dollar and some easing of trade tensions, investors are feeling a bit braver. They're selling their safe haven gold to buy riskier assets like stocks. The strong dollar also makes gold, which is priced in dollars, more expensive for buyers using other currencies, which hurts demand. Gold's price is like a fear gauge for the market. Right now, it's telling us the fear is dialing down a notch. Let's not forget what's on your dinner plate. Agricultural commodities, things like wheat, corn, and soybeans are always important to watch. Their prices are influenced by a crazy mix of factors: weather patterns, global demand, especially from China, and the strength of the dollar. While we haven't seen any massive price spikes recently, these are the commodities that have the most direct impact on your weekly grocery bill. When the price of corn goes up, so does the cost of everything from your cereal to the feed for livestock, which eventually makes your steak more expensive. Keeping an eye on these markets is key to understanding the cost of living. So to recap the week, we're watching a complex dance. In the US, we're looking for signs of economic health. Globally, it's a mixed bag with China's weakness and Japan's potential awakening. The strong dollar is the big story in currency markets, while bond auctions will test investor confidence. Oil and gold are reacting to geopolitical whispers, and crypto remains a wild card. For the average person, this all boils down to the cost of borrowing money, the price of gas and groceries, and the performance of your long-term investments. The game is on and you've got to stay in it to win it.